For the most part, in the United States, banks tend to live in a time of tranquility, in a time of peace. The people who are depositing money in the banks have faith in the banks. They put their money in there, they leave it there. Oftentimes, the banks are loaning out money. They trust that the people that they're making these loans to can repay them. And very rarely do we have any really major disruptions within the banking industry. Although banks can fail. Banks tend to fail whenever the value of their assets fall below the value of their liabilities or the cost of their liabilities. So whenever the asset value is lower than liabilities, they're insolvent and they tend to go bankrupt. This can happen occasionally, although it doesn't typically happen on a grand scale, except for 3 times in the United States history. These 3 times were the bank failures of the 1930s, we had the savings and loan failures of the 1980s, and then the banking crisis of 2008. So in this video, we're going to talk about the 3 major financial failures that we have seen here in the United States, starting off with the bank failures of 1930s. At this time, in the 1930s, 8,800 banks failed. That's 8,800 banks, mainly rural banks. So whenever the depositors came in and put money in these banks, they were given 2 basic assurances. They were saying that they were going to require a certain amount be left in the bank as required reserves for people whenever they wanted to make withdrawals, either on their time deposits or their demand deposits. At the time, the required reserves were 7% for demand deposits and 3% for time deposits. So if we break that down a little bit, and on all demand deposits, so these are your checking accounts that you often write a lot of checks out of, and that money is moving very frequently. So on these demand deposits, the bank was able to loan out 93 cents of every dollar that came in. So 93 cents of every dollar they loaned out and only had to keep 7 cents in the bank. And these are on the demand deposits where they're writing a lot of checks. Time deposits was even worse. 3% had to be kept in the bank for rural areas where there often wasn't a lot of money being transferred in and out. So that was the first assurance, is that they would be able to get their money out of the bank whenever they wanted because of these required reserves. The second aspect was loans were secured by collateral. So it basically said that if you default on this loan, we're going to come and take whatever the loan's on. So these loans in these rural areas, remember it's rural banks that mainly failed, so these loans were made mainly to farmers. So they were using the equity of their land as collateral. So they basically got the assurance saying, if you default on your loan, we're going to come and take your land. Well, no farmer wants to lose their land. That's their livelihood. That's their life. So the assurance was made that, well, no farmer wants to lose their land, so they're going to do everything they possibly can in order to keep their land and make that loan happen. So loans were secured by collateral. It didn't really even look at how much they were making or how much they were spending or their cash flow or anything like that we often look at today. It was looking at purely, is this land worth enough to cover the cost of the loan if they default? So everybody was happy based off of these 2 assurances, but it wasn't enough. Because in the late 1920s, early 1930s, farmers started facing bad weather and low crop prices. So because of bad weather and low crop prices, they had a low supply and low prices. They couldn't make their payments anymore. They couldn't make the payments on the land. They couldn't pay off their loans. So all of them were in the same boat. And they were all pretty much forced to sell in droves. So what happened was, one farmer sold his land, and then the next one, and then the next one, and then next thing you know, all the farmers in an area were forced to sell their land. Well, what happened? Because everybody's selling their land and nobody's buying, it drove land prices down. Very drastically did they go down. So land prices fell. Well, now that the land prices fell and people were defaulting on their loans and the banks were coming in and taking over these foreclosed lands, what happened? Well, now all of this land that used to belong to farmers but now went to the bank because they couldn't pay off their loans was being repossessed by the bank, and the bank's assets now are that land. Well, the value of those banks' assets began to fall because the value of the land fell. Basically, all of the bank's assets were on the loans on the land, and as the land prices fell, the value of their assets fell. So we said that in the beginning that banks could fail whenever the value of their assets fell below the cost of their liabilities. Well, that's what was beginning to happen. The assets began to fall in value so far that they became insolvent. Many of them were going bankrupt because of that, because farmers were forced to sell because they couldn't make their payments because of bad weather and low prices. So as the bank assets fell, concerned depositors began to realize this. They kept looking back and saying, man, if they can't get the money from the loans, then where is my money at? My money should be in that bank, and it's not because it's tied up in these loans and they can't get these loans repaid. So I'm a concerned depositor and I want to go to the bank right now and get my money out. So what happened? At first, concerned depositor runs to the bank, withdraws all of their money because they're worried about the bank collapsing. Well, then somebody else sees that person running to the bank. Then the next person sees that person running to the bank, and they all start running to the bank together as a mass crowd. And it causes what we know now as bank panics. And what it was these concerned depositors were worried that the bank was going to go bankrupt and they weren't going to be able to get in there and pull out their deposits. So as a result, a mad rush of people would go to the bank and start withdrawing their money just as quickly as they possibly could, and the bank ran out of money. At this time, most, if not all, depositors in some of these rural banks would lose money. They lost their deposits because the bank literally did not have enough in there in the vault to cover all of these withdrawals. Why? Because they had low required reserves. And also, these loans started collapsing, so everybody who had money tied up in the bank would go to these banks. So it led into these bank panics. And if you ever seen the movie It's a Wonderful Life, and I actually put the video in y'all's slides, but within the movie that's called It's a Wonderful Life, it shows a bank panic or a bank run where everybody's running to the bank and they're trying to withdraw money, and it was a very nice scene where they were able to get through the day. But many banks could not. Many banks actually, the depositors withdrew too much money that they literally had nothing in the bank left, and they would have to close their doors signifying they didn't have any money. And as a result, many of these banks, 8,800 of them, began to fail in these rural areas. So what became as a result of this bank failure of 1930s? Well, we had the Great Depression following right after that. Partially because of these bank failures, but also because of bad weather and low prices. It led to the Great Depression that rocked the nation for many years. We also found that the required reserves were increased for up to 14% for demand deposits, 6% for time deposits. We also had the FDIC created. The FDIC stands for Federal Deposits Insurance Corporation. It was originally established under the banking system or under the federal system, and then later became a private entity. So it was established through the government to become a private entity later, and now it operates as an individual corporation, but it can draw from the U.S. Treasury if needed. And it's an insurance corporation to cover all of these deposits that people may not be able to withdraw whenever the bank runs out of money. So those two things were the main results that came out of the bank failures in the 1930s. So everything kind of was going good. After the 1930s, they came in there and they started making a lot of rules, a lot of regulations. They set everything up to where, we can't have another Great Depression, so we're going to do everything we can to avoid that. Right up until about the 1980s. In the 1980s, the savings and loan failures in the 1980s cost $550 billion. That accounts for $2,200 for every man, woman, and child. So think about it this way. If you were a family of 4, you would have to pay $8,800. And every family of 4, every family of 3 would be $6,600. Every family of 5 would have to pay $11,000. And all of them at the same time to be able to cover the cost of this savings and loan failure of the 1980s. So following 1930s, regulations were passed. Many regulations were passed on the banking industry. And one of these regulations limited financial intermediaries. So what it did is it broke up the financial intermediaries and said, you're a commercial bank, you're a savings and loan bank, you're a merchant bank, you're this type of intermediary, and it defined them all. And then it started specifying what they could and couldn't do. So they said a commercial bank, you can make these kind of loans, you can accept these kind of deposits, you do this, you have this much of a required reserve, and on and on and on. Then it went to like the savings and loan bank, and it said you can have this much interest, you can accept only time deposits, you can't handle demand deposits, and you can make home mortgages and all of these other things. And it just went on and on and on. It specified who could do what. And a result of it was the savings and loan could only accept time deposits, and as a result, they could pay 5 1/4 interest to all depositors. So savings and loans could pay out 5 1/4 interest to all depositors on time deposits, but a commercial bank could only pay 5% interest. So if you are a greedy person, or if you're just a person of looking to maximize your profits, and you have a little bit of extra money and you want to go put it in a savings account, where are you going to put it in? You're going to put it in a savings and loan earning 5 1/4%, or a commercial bank earning 5%. We're going to put in the savings and loan at this 5 1/4. So what was happening was the savings and loan basically held a monopoly on mortgages, because they could offer an interest rate slightly higher than the commercial banks, and that was regulated by these regulations that came out of the 1930s. So they could hold these time deposits and get a lot more income, or a lot more deposits, because of that. And then they turned around and they made these big home mortgage loans at 8%, and they were borrowing at 5 1/4. So everybody was happy. They borrowed at 5 1/4, they loaned out at 8%, everybody went home, and everybody was doing good. Well, President Ronald Reagan came in, and he developed, or through his presidential time, they came up with this sort of economics called Reaganomics. Reaganomics believed in deregulating industries. After the 1930s, a lot of industries began to become regulated, such as the trucking, airline, railroad, and the banking. And then Ronald Reagan came in and said, we need to deregulate some of these industries. The reason we're going to deregulate them is because we are losing in terms of compared to other countries. We are not being as innovative, we're not being as competitive, and the reason for that is we're so highly regulated, we cannot compete with another country. So as a result, he said we need to deregulate the banking industry, we need to deregulate the trucking, the airline, the railroad industry, and a few others. So as a result, he came in and started deregulating the banking industry. As a result, he got rid of some of these regulations that was passed after the 1930s, and what became of it is other financial institutions moved in on the mortgage industry, moved in on mortgages. So prior to Reaganomics and the deregulation of it, the savings and loan basically held a monopoly on mortgages. Why? Because they could charge lower interest than other banks for mortgages, and higher interest and pay higher interest to those depositors. So whenever other financial institutions moved in, it increased competition. So now it got rid of this whole 5 1/4 and 5% interest mark. So other banks began to pay their depositors higher interest rates. So if you're a savings and loan bank, you have either one or two options. Close up and fold in and just say, we're not doing this business anymore. Or you can remain competitive and start raising your interest rates as well that you're paying to depositors. So that was the first thing that happened. The savings and loan raised interest rates for their depositors. Next thing you know, they're paying out maybe 10% interest to depositors. That was the only thing they could do to remain competitive compared to, say, commercial banks. But as a result, they also wanted to remain competitive on their interest rates being charged for home mortgages. So next thing you know, they're lowering interest rates for home mortgages. So now they're paying depositors 10 cents or 10% for every dollar, while they're only charging, say, 8% or 6% on home mortgages. So they're borrowing money at 10% and loaning it out at, say, 6%. Well, if you do the math, that doesn't really come out there, because typically you want the price at which you're borrowing at to be lower than what you are selling it at. So you want your price that you're buying to be lower than the price that you're selling at. Well, what was happening in the 1980s, this wasn't the case. They were trying to remain competitive, so the interest rates for deposits went up, interest rates for mortgages went down, and as a result they became flip-flopped in the sense that they were paying more on deposits than what they were receiving on loans. As a result, 1,000 of 3,000 banks, savings and loan banks, failed. 1 out of 3 savings and loan bank failed. And they also believe, they did an investigation, and they believe that 40% at least were involved in some sort of criminal activity. 40% of these savings and loan institutions were involved in some sort of criminal activity. And it was all due because of Reaganomics and the deregulation of the banking industry. So, those banks failed, and it wound up costing the United States $550 billion. It's estimated that still 5% of our national debt is attributed to this failure right here. So then, after that, we managed to go get everything back on track for about 20 years. And then we had the banking crisis of 2008, also known as the housing crisis of 2008. If you're watching this video, chances are you still remember something about that. Maybe you were affected by it as well. You probably weren't affected by the 1930s. Some of y'all might have been affected by the 1980s, but I'm guaranteeing just about everybody was affected in some way, shape, or form by the 2008 banking crisis. So, the deregulation back in the 1980s led to changes in the mortgage industry. We already saw that back over here. Mortgages shifted from savings and loan banks to maybe commercial banks and other financial institutions. So these deregulation changes led to changes in the mortgage industry. Prior to these deregulation, loans were very conservative. Prior to this 1980s debacle, we found that loans were very conservative. Home mortgages were loaned out at 80% of the value of the house. So whenever you went in to get a loan, they would only give you money for 80% of the value of the house, and they required 20% down, or sometimes even more than that. So they were very conservative. They looked at making sure that people weren't going to default on their loans. After this whole deregulation, we find that people aren't near as conservative. So at the time, 2 government-sponsored enterprises were started. What government-sponsored enterprises are enterprises that the government forks over the capital to start them up, and then they pretty much turn that business loose and let them operate as their own entity. And these 2 government-sponsored enterprises were the Federal Mortgage Association, also known as Fannie Mae. We also had the Federal Home Loan Mortgage Corporation, known as Freddie Mac. So these 2 corporations became a very important player in leading up to the 2008 banking crisis. So what these 2 enterprises were involved with was they bought mortgages from banks to sell them to the public. So at the time, all of these loans were very conservative, so they said, well, why not take the risk off of the bank? We're going to buy these mortgages from the bank to where they don't have to worry about the risk anymore. We're going to sell it to the public, and it's a win-win because the public's going to make money off of the interest on those loans, and the banks don't have to worry about the risk anymore. And on top of that, all of these loans are conservative, so nobody's ever going to lose. That was the way it more or less was set up. And they became known as CDOs, Consolidated Debt Organization, or organisms. Forgot what the O really stands for. I'm sorry about that. But these CDOs were basically bundled up mortgages. They were bundled up home mortgages. And then they were turned around and sold to the public. And the public loved them for several reasons. The first one is there was an implicit guarantee. It was an implicit government guarantee. The government was backing these 2 sponsored enterprises, these government-sponsored enterprises. They were kind of backing them a little bit. So they said, well, anything that comes out of Fannie Mae and Freddie Mac and has the word federal in it must be backed by the government. So there was this implicit government guarantee. It was also low risk in the beginning. It was low risk because all of these mortgages were very conservative. And even the ones that weren't all that conservative, they were bundled in with a bunch of conservative ones. So as a result, they were all fairly low risk. They're also liquid. People loved them, so they bought and sold them, and they were a very liquid asset, meaning that you could pretty much find a buyer for, if you wanted to sell one, you owned one, you want to sell it, you can generally find a buyer for it, just like you could generally find a seller for one because they were so liquid. So then we had two new players come into the game. We had investment banks and different loan originators. So investment banks were not so much under the scrutiny of commercial banks. They were highly unregulated because they were kind of a new deal, and they didn't really deal with demand deposits or anything like that. What they did was they bought and sold investments. So they were very unregulated. So they got into buying and selling CDOs. They got into getting in there and consolidating debt, buying mortgages, creating their own CDOs, and selling them to the public. As a result, they created competition with Fannie Mae and Freddie Mac. So now we had these investment banks competing with these two. Another deal was we had different loan originators. Originally, the loan originators were the commercial banks. These were the people actually making the loans. Or we had the savings and loan industries making these loans. This wasn't the case anymore because investment banks and these Fannie Mae and Freddie Mac were looking to buy as many home mortgages that they could. We saw different enterprises begin to pop up, and their whole deal was just make a loan. Their only objective was, we're going to make a home mortgage loan. And once we make a loan, we're going to turn around and we're going to sell it to one of these three people. And once we sell it to one of those three people, our hands are clean. We're done. We have no risk. So these people were making a loan, and they weren't holding on to it, so the risk was very low, and they were selling it to somebody else. So what did they care about how risky the loan was? Because there was absolutely no risk to them. As long as a person didn't default on it overnight, which is virtually impossible, there was absolutely no risk for these new loan originators. So their whole goal was just get numbers because they were paid by the numbers. They were going to make as many loans as possible and just sell them as quickly as possible. So they accepted no risk for it. So they made very bad, very risky, high-risk home mortgage loans. Remember in the beginning we said they were very conservative. They were saying that you need at least 20% down and we're only going to give you 80% of the value of the house as far as a loan. Whenever we started getting into these loan originators, these individual loan originators, they were often making loans of 100% or more than the value of the house. And they were requiring nothing down. They were doing variable interest rates. They were doing all of these things that were not conservative at all. They were very high risk. But what did the loan originators care? They were just there for numbers. And they weren't holding on to the risk. So as a result, loans were no longer conservative. And everything was going okay as long as housing values were going up. But then in 2007, we saw the housing crash. We saw the value of houses, value of real estate begin to plummet. Whenever that began to happen, the value of these CDOs became virtually worthless in many cases because the whole value of the CDO was based off of the land value because the whole note, the whole mortgage was based off of this home value. So whenever the housing market crashed, we saw that many of these CDOs became virtually worthless. So what happened as a result? We had 5 major large investment banks in New York City fail. The United States government had to provide a $800 billion bailout for toxic CDOs. $800 billion. We said that this was a major debacle that still accounts for 5% of the national debt, and it was only $550 million. This was $550 billion. This was $800 billion for toxic CDOs. They also had to pay out $123 billion to AIG. And the reason they paid that out is because they believed that AIG was too big to fail. We had a 40% drop in the stock market. So this right here led into the Great Recession. We said that this one more or less led in the 1930s debacle led into the Great Depression. That was the beginning of it. This one led into what we now know as Reagan's recession. It was a minor recession, but it was there. This one led into what we now know as the Great Recession. So in all three of these cases, these are macroeconomic events that occurred that led into more macroeconomic events such as the Great Depression, Great Recession, and then also Reagan's recession. So we had the bank failure of the 1930s, and it basically occurred because people were using equity of their land as collateral on the debt, low required reserves, and whenever bad weather and low crop prices forced everyone to sell, so the value of the land fell, causing these banks to go bankrupt. The 1980s savings and loan failures occurred because of deregulation in the banking industry, caused competition among different financial institutions, causing interest rates for deposits to go up, interest rates for loans to go down, causing these banks to go bankrupt, causing an $550 billion deficit for the United States. We had the 2008 banking crisis where we had Fannie Mae and Freddie Mac emerge. They were creating these CDOs. The investment banks and loan originators began to change, and as a result of the housing crash in 2007, we saw a $800 billion bailout for CDOs and a $123 billion bailout for AIG.